Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. Today our group will present about the financial aspect topic. First of all, I'm gonna tell you very briefly about this topic. The financial aspect of financing encompasses a range of activity and consideration to successfully manage and allocate financial resources to meet the funding needs of individuals, projects, or business. The most important stage or step in bank financing process include figuring out how much a loan will cost or how much profit financing will make. Besides, we will learn about the conventional and Islamic banks financing. Although conceptually Islamic banks financing are significantly different from the conventional bank lending activities, Islamic bank in many cases rely on conventional banks calculation method. So, not to waste our time further, let's move to the next slide to know more details about this topic.
So, I would like to present about time value of money, which is TVOM. Time value of money is a financial concept that states that money has different values at different point in time. In addition, money is worth more now than the same sum will be at a future date due to its earning potential in the interim. This core principle of finance holds that provided money can earn interest, any amount of money is worth more than the sooner it is received. So there is a five important element in time value of money, which is present value, future value, time and interest, discounting and compounding, and the last one is risk and uncertainty. So I will pass to the next presenter to tell the detail of each element.
Okay, so for the next slide, I will present about the time value of money from Islamic perspective. Because Islam defines money differently from the conventional system, the time value of money in the Islamic perspective is entirely different from the conventional one. Interest, known as riba, is considered usually and is forbidden under Islamic law. Islam forbids making more money through the concept of the time value of money because it involves the element of riba. Furthermore, by utilizing the principle of interest, time value of money to produce more money through lending activities, a person may easily get money without having skill or expertise. This results in a society that is full of greed, speculation and immorality. Next, Sharia does not prohibit any increment in the price of a commodity in any sale contract to be paid at a future date. In addition, Islamic finance operates under principle that promote ethical and fair financial transactions. In a borrowing or lending relationship, Sharia prohibits considering time value of money. In short, the time value of money is acceptable in Islam for the pricing of assets and their usufruct, but it is not acceptable for any addition to the principle of loans or debt because the Sharia considers a loan to be a wishes act from which no benefit can be derived.
There are 5 core principles of time value of money, which is future value, present value, time and interest, discounting and compounding, and lastly, risk and uncertainty. For the first, I will explain about future value. Future value is a current asset at a future date based on an assumed rate of growth. The future value is important to investors and financial planners as they use it to estimate how much an investment made today will be worth in the future. The second one is about present value. Present value is amount of money today is worth more than that same amount in the future. In other words, money received in the future is not worth as much as an equal amount received today. Third, about time and interest. Time and interest is used to translate the different time periods. Normally, time and interest is expressed in the percentage to find out the value of money at the present or in the future. And 4 is discounting and compounding. Discounting and compounding is the process in which an asset's earnings from either capital gains or interest are reinvested to generate additional earnings over time. And lastly, about risk and uncertainty. In all decisions, there is an hesitancy of risk and uncertainty. So, care should be taken to recognize and to measure the extent of risk associated with the asset before taking the decision to invest on risk asset.
Now I will talk about key elements of pricing mechanism. First one, private mortgage insurance or PMI. Lender require mortgage insurance if the borrower contributes less than 20% of the home's value. The lender is protected against not enough payment by PMI. A portion of PMI costs are included in monthly mortgage payments. Second, closing costs. Mortgage and home purchase costs include in closing costs. The cost of the recording, title insurance, engaging an attorney and other services could be additional expenses. Closing costs vary depending on the area and loan transaction and are paid at closing.
Another key elements of pricing mechanism is interest rates. Interest rates are used as a basis for conventional housing finance. It's a yearly percentage for borrowing money, APR. Interest rates are affected by the degree of creditworthiness, lack of loans, loan-to-value ratio, and market conditions. Low-risk borrowers with higher credit scores get cheaper interest rates. The second one is points. Lenders can allow borrowers to make points ahead of time in order to reduce interest rates. The interest rates of the loan will be reduced by 1% for each point. For example, an interest rate reduction of 0.21% will be possible if 1 point was paid in advance. Points should be based on a borrower's financial situation and the time he expects to live at his place of residency. And third, about origination fees for processing loan applications, underwriting, and the cost of administrations, lenders can charge an initial fee. The loan origination fees should normally be expressed in percentage terms and may differ from one lender to another.
The base rate can be defined as the standard interest rate that banks and other financial organizations use to determine interest rate on variable rate mortgage and other loans for conventional house financing. Interest rate that the bank refers to before it decided on interest rate to apply to your home loan. It is calculated against each bank's cost of funds and statutory reserve requirement that called an SRR, along with the borrower's credit risk, liquidity premium, operating cost, and profit margin. In short, banks in Malaysia can now determine their own interest rate based on a formula set by the central bank and using BNM rate as a benchmark. Although the formula is by Malaysian Central Bank, each bank is able to package better deals for its customer without intervention from BNM, depending on business, vitality, and type. For example, if the bank is performing well in the consumer banking sector, they will be able to offer more attractive home loan packages.
Credit analysis is a type of financial analysis that an investor or bond portfolio manager performs on companies, governments, or any other debt issuing entities to measure the issuer ability to meet its debt obligations. Credit analysis evaluates the effectiveness of debt instrument issued by companies or entities to measure the entity's ability to meet its obligations. The outcome of the credit analysis will determine what risk rating to assign the debt issuer or borrower. An example of a financial ratio used in credit analysis is the debt service coverage ratio, DSCR. DSCR is a measure of the level of cash flow available to pay current debt obligations, such as interest, principal, and lease payment. A A DSCR below 1 indicates a negative cash flow. For example, a DSCR of 0.89 indicates that the company's net operating income is enough to cover only 89% of its annual debt payments. In addition to fundamental factors used in credit analysis, environmental factors such as regulatory climate, competition, taxation and globalization can also be used in combination with the fundamentals to reflect a borrower's ability to repay its debt relative to other borrowers in its industry.
For this slide, I will talk about conventional home financing calculation. This refers to mortgage loans that are not guaranteed or insured by a government organization, such as the Department of Veterans Affairs (VA) or the Federal Housing Administration (FHA). Conventional home finance terms and calculation may change depending on the loan amount, interest rate, and loan term. At the slide, it shows the conventional house loan calculation. Let's say the cost of half 200,000. Firstly, the customer pay 10% to purchase the house from the developer. That is Rm20,000. Then the bank will finance the balance of the amount that is Rm180,000. The bank and in interest for 20 years Rm416,889.60. This amount divide to 240 to get monthly installment. So the amount customer need to pay to bank Rm1,737.04.
There are two products of Islamic financing, which is home financing and vehicle financing. For home financing, Islamic bank will use musyarakah mutanakisah. Musyarakah mutanakisah is used concept of musyarakah, which is partnership, al-bai', which is sale, and possible ijarah, which is rent, depending on the subject of partnership. Begins with two parties such as the bank and the customer, purchasing certain assets, for instance house, as partners. One of the parties, usually the customer, start renting or utilizing the asset. In return, the customer shares profit with or payments monthly rent to its partner, the bank, according to the agreed ratio. Second is vehicle financing. Islamic bank will use al-ijrah thumma al-bai', which is ITAB. ITAB process. First, Islamic bank is approached by the customer for request of financing. Second, the asset is purchased by the bank from the vendor. Third, the payment are made by the bank to the vendor, and 4, the asset is being leased to the customer. 5, the payment of ijarah rental are made by the customer, and lastly, the ownership of asset is transferred to the customer.
Assalamualaikum to everyone. My name is Siti binti Azmi. My metric number is 072847. Let's proceed with the presentation, which I'm going to explain on BBA home financing calculation part. By Bitaman Ajib, BBA refer to a sale and purchase transaction of an asset to be paid on a later date based on price, which includes a profit margin agreed to by both contracting parties. BBA are designed to comply with Sharia principle, which prohibit interest and promote ethical and socially responsible financial transactions. There are 4 tools we will use in order to measure these BBA calculations. The first one is through the annuity factor, which is used to determine how much money will be paid out in the future at specific points of time under an annuity agreement. The second tool is periodic payment, which means the amount paid at regular intervals such as weekly, monthly or yearly for a period of greater than 1 year. While for the rest 2 tools are selling price and profit amount. Selling price stands for the amount customer pays to purchase a product or service and includes the value that covers the cost of selling, the offering, or the cost of goods sold. While price amount stands for the amount of money that you gain when you are paid more for something that it costs you to make, get, or do it. To calculate this BBA, we will use the computation method. BBA computation method involves adding a profit margin to the cost of the property, and the total amount is then divided into equal installments over the agreed financing period. The buyer agrees to make the regular payment, which includes both of the cost of the property and the profit margins. The profit margin is determined and agreed upon by both parties at the beginning of the transactions. The formula, that will be used are the same as what have been stated or shown in this slide. Let's go through with some examples to solve this BBA calculation using this method. For instance, WANI applies to Islamic bank for financing under the concept of buy bitaman ajil. Let us say the purchase price for the house is 700,000 ringgit and profit rate is 8%. The financing period of 20 years, which means that WANI has to pay the sales price in 240 installments. By applying those formulas, we will get the answer for each aspect. In the annuity factor, we will get the final result, which is 0.008 something. And for the periodic payment formula, by multiplying the amount of annuity factor with purchase price, then we will get 5854.96. And for the selling price formula, we will multiply the amount of periodic payment with the total number of periodic payment, then we will get 1405190. Last but not least, for the profit amount formula, we will subtract the amount of selling price with purchase price, and the final answer will be is 705190. So that's for the calculation part on BBA home financing calculations. I will pass it to the next presenter. Thank you.
So from the previous slide that we have been discussed before, we can summarize that one of the ideas of finance is time value of money or TVOM. We say that the value of money changes with time. The fundamental ideas of TVOM are future value, present value, time and interest, discounting and compounding, risk and uncertainty. The way Islamic finance works is that it forbids what is known as riba in all of its transactions by encouraging moral and virtuous value. Okay, essential element of the pricing structure like PMI, closing costs, interest rate, origination fees, and points are also mentioned. This topic also include BBA calculations, annuity, term payment, price of sale, and total profit are the parameters that will be considered in the BBA calculation. That's all from us now. We hope you learned something from this presentation.